it is sold or otherwise transferred, and the full value consideration will have to be taken on the basis of the fair market value on the date of conversion. See, I'll give you an illustration. In year 1, you have a capital asset. Year 4, you convert it into stock in trade. Year 4, you convert it into stock in trade. Year 6, push it into JDA. Year 9, get the flats. Year 12, sell the flats. Repeat the flats. Year 1, capital asset is acquired. Year 4, conversion. Year 6, JDA. Year 9, flats coming in. Year 12, flats going out. Now, what does 45(2) say is that you pay tax in the year in which it is sold or otherwise transferred. Question is year 6, year 9 or year 12. Can't be any other option. Leave it at that for a while. Now it says, how do you compute the capital gains? Fair market value will have to be taken. As of what? Which year? Year 4. Though you may pay tax in year 12 or in year 9, fair market value at the time when you convert, that is in year 4, will have to be taken at the full value consideration. Then you know the cost which you have incurred in year 1. You index it up. Now, you index up to what stage? You index up to what stage? You have Karnataka High Court decision in Rudra Industrial Commercial Corporation, 20taxman.com 611, where the Karnataka High Court said, no, you can index up to year 12. Looks a little illogical, right? Because fair market value as of year 4 will have to be taken means you have to quantify your capital gains and determine the tax, keep it in the limbo, don't pay, but pay it in the year in which the asset is eventually transferred. That is how we all have understood. The Karnataka High Court says, no, you can keep on indexing, right, till it is sold or otherwise transferred, although you are stuck to the fair market value as of year 4. That means, assume in our example we decide that we pay tax in year 12, fair market value is as of year 4, but indexation of cost is from year 1 to year 12. Now, as we continue this, let us say year 9 comes. We decide that in year 6 we don't pay tax. What will happen in year 6? JDA. Year 9, what will happen? You get the flats. Do you pay tax in year 9? Yes or no? See, you had converted land into stock in trade. You give away one stock in trade and you get another stock in trade. I assume that when you have converted land into stock in trade, the building that comes to you is also stock in trade. It can't be capital asset. Because in the course of a business, you turn your stock in trade over. So now you get stock in trade by way of the flats. The question for consideration is exchange of one stock in trade for another stock in trade. Would it mean profits to be computed under section 28 of the Income Tax Act? Now, if you refer to motor industries case in 66 ITR 692, in the context of section 41 of the Indian Income Tax Act, the Supreme Court said, no, it has to be a sale. If it is a barter, if it's a barter, no income arises, no income accrues. You don't have to pay the tax. But then later on in 147 STC 57 in Dampur Sugar Mills case, in the context of sales tax, Supreme Court went on to say that, look, once the consideration is fixed in terms of monetary value, how such consideration is discharged, whether by way of cash or by way of kind, should not really matter. For example, in the JDA, we would have said the consideration for the land is 5 crores to be discharged by giving 10 flats. To be discharged by giving 10 flats. Then Dampur Sugar would trouble you to say that, look, the monetary consideration is fixed. It is discharged in kind, which is like, like some sort of a needless two-way traffic, which has to be not really bothered about. JB Boda case, 227 ITR 223 Supreme Court. Two-way traffic and all you should ignore. It is essentially same. Therefore, it translates into income and you have to pay the tax. And the decision of Supreme Court in Orient Trading in 224 ITR 371, where one stock in trade, shares were held as stock. Some company shares, so Britannia Limited shares were held in stock. The dealer exchanges shares in Britannia for shares in Hindustan Liver. Swap. Does not offer it to tax. The Supreme Court says no. Conversion of one stock in trade into another stock in trade would also mean an activity in the ordinary course of trade resulting in profits and gains, and you have to offer it to tax. So if this logic were to be considered, in year 9, you will have to end up paying tax. Now, when you pay tax in year 9, it doesn't stop there. You will have 43 CA coming into play. What is happening in year 9? An exchange is happening. Undivided land is going. Flats are coming. What does 43 CA say? For the purpose of computing profits and gains arising from transfer of immovable property being land or building, if the consideration that comes to as a result of transfer happens to be less than the guidance value will have to be adopted. So when you go for conversion of capital asset into stock in trade, you have all these nuances to take care. It is not as easy as it used to be. You have to be careful. You will have 43 CA coming in. You will have Karnataka High Court in Wipro troubling. So all your efforts may eventually go in vain and may put a client into greater trouble than he would have been had it been the straightforward case of transfer of a capital asset. So these are some of the nicer aspects which will have to be kept in mind. Do I conclude mentioning one topic? Just one topic, are you fine? Yeah. An interesting proposition of 50 capital D. With a caveat, of course. All these tax plannings will have to be understood with the caveats associated with it. Most important caveat is the tax planning suggestion is made with the selfish interest in mind. Now, what does 50D say? For computing capital gains, if the consideration is indeterminate or cannot be ascertained, then it says the fair market value of the outgoing asset will have to be taken to be full value consideration. Typically, when I exchange one asset, one capital asset for another asset, what should be my consideration? Is the value of the asset going out or the asset coming in? Commercially, what do you understand as your full value consideration? Is it the fair market value of the asset going out or fair market value of the asset coming in? No, it has to be what comes in. This is the principle enunciated by Supreme Court way back in 66 ITR 622, George Henderson's case. George Henderson's case, Supreme Court said, in the scheme of an exchange, in order that you compute capital gains, the fair market value of the incoming asset will have to be adopted and not the value of the outgoing asset. Now, 50D is a departure to this principle. Because what is incoming, we don't know when and how, in what value it will come. In a JDA, we don't know when it will come. We don't know its value as of now. So what now they provide under section 50D is, see, the fair market value of the outgoing asset will have to be considered. Now, when you get into a JDA, where you don't fix the monetary value, you say, my land is given to builder, he will have 60% share, and I will have 40% share of the built-up area, which means I'm transferring 60% of the land to the builder for 40% of the built-up area. We do not know the value of it as of this stage. Courts have taken different views. Some courts have held cost to the builder will have to be taken. Some courts have held value after 4 years will have to be estimated and will have to find out the net present value of the same by adopting a suitable discounting factor will have to be adopted. But there is no hard and fast measure of doing it. On the basis of this, Hyderabad Tribunal, starting with K. Radhika case, consistently has been holding that in the JDA, consideration is not ascertainable, cannot be determined, no tax. Now, to undo this, they brought in 50D to provide that the fair market value of the outgoing asset will have to be adopted. Right? Now, this came in from assessment year 1314 onwards. Introduced by Finance Number 2 Act of 2012. Finance Act of 2012 is notorious, for what reason? Could you guess? That is why board has not come out with a circular explaining 2012 amendment. Vodafone decision is upset in 2012 Finance Act. They don't have the guts to come out with the explanatory circular. So they are not brought out any explanatory circular for Finance Act of 2012. Now, they introduced 50D. So we don't have the explanation why have they introduced, but then we believe that through the memorandum that some decisions have been taken to say that if the incoming assets value is unascertainable, capital gains computation would fail. So we're bringing it in, which means what? While they are notorious for making retrospective amendment, because most of the amendments in Finance Act 2012 are with effect from 1/4/1961 for the removal of doubts from 1/4/1961. So these people are having doubts right from 1/4/1961. So whereas 50D amendment is an exception which has not been made retrospectively, which has been made prospective. Now, 367 ITR 466, large bench decision of Supreme Court in Vatika Township's case says, unless it is expressly stated or by necessary implication it can be considered as retrospective, all amendments are to be treated as prospective. That means up to assessment at 1213 in all JDA cases where you'll have the consideration coming in kind after a few years, you don't have to pay tax. Again, a defense mechanism. Now, after 1213, you have 50D in place. How do you make best use of 50D? Take an example where you enter into JDA today, right? Are you better off paying tax now or after 4 years? If the tax quantum remains the same, yes. What if you could pay some marginal tax now and immune yourself from all the taxes in respect of the appreciation? Don't you like it? So now, get into a situation where have a revenue sharing arrangement with the builder. Have a revenue sharing arrangement with the builder. Let us say I am the landlord, you are the builder. I have given away my land to you. 40 flats to me, 60 flats to you. What do I do with 40 flats? I have to sell. I would tell the builder, look, on my behalf, sell these 40 flats, pay the consideration to me. It's called revenue sharing. I have to take some care to see to it that the department would not treat me as a businessman. So I shouldn't be considered as engaging in a trade. They should accept that I am holding it as an investment. Now, what I'll do, year one, when I enter into JDA, I pay the tax. On what basis? Fair market value of outgoing land. Let us say, fair market value of outgoing land may be 1 crore. I pay tax on 1 crore. Whereas 40 flats, which when sold by the builder, would translate into, say, 5 crores. I would say, on what do I pay tax on 5 crores? I've already paid tax. The tax which I paid now has answered all the taxes in respect of the future consideration that would flow to me. So you should consider this seriously. Look at the negatives and the adverse views one would take and accordingly plan it out. And if well planned, it could mean you paying tax on 1 crore and not on additional 4 crores that would come later on as a result of revenue sharing arrangement. Just think over this. You could have disagreements with me, so be it. So like this, you have different avenues which you could, explore or at least make best use of the provisions. For paucity of time, I may not be in a position to discuss all these. More than what I have discussed would still remain pending insofar as landlord is concerned. When it comes to developer, we have several other issues like ICDS 3, which is now come in for construction contract, ICDS 4, revenue recognition, 43CA implication for the developer, and we'll have all these for the developer. Maybe on a better occasion where we have like a larger time available to us, we will endeavor to discuss this. I would thank the organizers for having called me for the seminar. I would thank each one of you for having shown a lot of patience to hear me out at this point of time on this Saturday. Yeah. Well, till such time the organizers would permit, you can ask questions. So I could, the easiest thing to answer your question is by saying I don't know. Please proceed. Yeah.
15% was my land and my share of flats, 85% of developer. I forgot to pay the taxes. And no, the department could come, and after 7 years, when the flats were ready, the flats were sold by the developer, and I got the proceeds. As a good taxpayer, I made the taxes by way of investment in under section 54F. Now, when I have made a calculation, see the deed value was say 1 crore, and the circle rate was say 1 crore 20. I have invested only 1 crore. So here I know that I will not be paid any extra tax under section 50C. Am I correct or not? Number one.
No. Don't make question too long so that I'll forget. I'll answer this part first.
Number two, my question is that under section 54F, there is a restriction not being a residential house. I have purchased the land, I have not made any payment of taxes, but ultimately the flats have been sold. Whether I am correct in section 54F or not.
Firstly,
Am I able to make you understand?
I guess so. Firstly, in 2007, you have entered into JDA. In respect of which property? Just the land. Right. When the subject matter of transfer is the land simpliciter, there is no fetter under section 54F. 54F would say that in order that you get the benefit of rollover, the original asset which you have transferred should be any long-term capital asset, not being a residential house. Now, in your example, if I understood it rightly, in 2007, what you have sold through JDA is a plot of land. So there should not be any difficulty in getting 54F. And you got the flats and you offered it to tax in which year as a good citizen?
2013.
In 2013, 54F wasn't amended as it, because it was amended by Finance Act of 2014 to restrict it to one house. So in fact, in 2013, if you had had multiple houses, you could have staked your claim of 54F in respect of all those houses, irrespective of the fact that the flats are not contiguous, flats are spread in multiple floors, in multiple areas. I guess your second question is answered?
Now my one question is remained.
No, that's what I've said. Second question is answered. No. Why I answered the second question was, I follow the principle of FIFO. What I first heard will be forgotten first. So, what I've last heard would be remembered. Now you will have to tell me what your first question was. Hold on. I'll answer your question. What was your first question?
Second question.
The first question.
First question was that it was a land. Now ultimately the flats were sold. 54 restricts that is not being a residential house.
See.
The land, but the flats were sold. So whether I will
See, it's like this. He eventually sold away, firstly he sold away land, right? He got flats. Later on he would sell away flats. Agreed? Now, first argument which according to me he should have taken is, when I sold away land, I gave the possession way back in 2007. Therefore, you should have taxed me in 2007. Now it is time barred. You can't trouble me under 147 because it's beyond the time of 149. So, whatever capital gains I had received in terms of 247.5 in 2007 on transfer of land now is gone. you can't levy tax. One aspect. So he wouldn't have to pay tax when he gets the flats, because he, according to section 247(5), ought to have paid tax in 2007, and department cannot tax you for a wrong year. Department has to tax you for the right year. Merely because you have paid the tax, you have not paid the tax in the right year, it is not open to the department to tax you in the wrong year. Chythanya's case, Supreme Court decision, 217 ITR 285. Just because the wrong person was taxed does not mean right person should not be taxed. Corollary is, just because you have not paid the tax in the right year, it does not mean that they can tax you in the wrong year. So you don't have to pay tax on transfer flat. So when the flats came to you, you don't have to pay the tax. When you sell away flats, those flats which had come to you, you are selling away. Flats are less than 3-year-old, right? Short term. Question of 54F would not apply. However, when you sold away those flats, what you sold away is not one asset, it is twin asset. It consisted of two types of consideration. One, the underlying undivided interest in land. The other one, the superbuilt portion. The lump sum consideration which you have received from the customer will have to be split between the undivided interest in land and the superbuilt portion. You get me? And even if it is a consolidated amount, in terms of Supreme Court decision in Best & Company's case, 60 ITR page 11, consideration could be split on some reasonable basis if it is not so split in the sale deed. So you have sold one flat to 1 crore. You have to split it on a reasonable basis as to how much of consideration would relate to sale of undivided interest in land and how much is towards the sale of the unit. The unit is short term, you don't get any benefit. The land is long term, you get the benefit. You can claim 54F for the land.
What about the circle rate and the deed value?
Huh?
I have invested only the deed value.
See, firstly, my answer to your first question now, which I made now, would alter your second question, because 54F is inapplicable for sale of units. Whatever units that came to you which you have sold, it's inapplicable, right? Now, you can invest in other houses in respect of net consideration attributable to sale of the undivided interest in land. Did you do so? You need not. You know why? Because you invested in further assets apart from these assets. Now, circle value of the undivided interest in land will have to be seen. Now, let us say circle value comes to 80 lakhs, whereas your appropriated consideration is 60 lakhs. Let us say you invested only 60 lakhs. Now your question is, are you liable to pay for incremental 20 lakhs under 50C? Right. There is a divergence of opinion on this. I think to simplify his question, I would not mix up all this. Take a case where you sell away a plot. Let's not get into this JDA. Sell away a plot. You get 1 crore. Guidance value, circle values, 1.5 crores. Under 50C, what is your full value consideration? 1 crore or 1.5 crores? How much money you have on hand? Just 1 crore, correct? Now, obviously you could invest only 1 crore. So you have invested 1 crore in another house and you satisfy all other conditions. Now question is, when you compute the capital gains, his question is, your full value consideration being 1.5, because it's deemed to be so under section 50 capital C, but your investment in new house being only 1 crore, do you get proportionately less deduction, correct? The views are, Bangalore Tribunal has taken a view that when you would compute 54 or 54F as the case may be, we will take full value consideration as 1 crore itself. Then we claim and quantify the deduction. But when you go to compute the capital gains, Bangalore Tribunal says, start with 1.5 crores as full value consideration, which effectively means you don't get the benefit of 50 lakhs. But other tribunals like Pune Tribunal and Hyderabad Tribunal have taken a decision that as long as whole of the amount that has come to you has been reinvested, you should not be made to pay tax, because it is impossible for you to be investing 1.5 crores when you have not received it. So there is a divergence of views of the tribunal. You don't have the decision of High Court as it on this, to my knowledge. Therefore, it has to be escalated, and we have to see as to what the High Court will have to say. But I belong to the school of thought that if merely because by law they say it is 1.5 crores, law would not say that I have to be investing 1.5 crores. Law says as long as whole of the net consideration I invest in another house, I shall get whole of the benefit under 54F. And you have to keep in mind the doctrine of impossibility of performance also as you interpret a beneficial provision like section 54, and you should not pay tax on the differential amount. Yes, sir. Last question? Or can I go on? Please. Yes, yes. No. See, you have to understand that merely because somebody deducts tax at source, that does not create a charge on you. Claim the refund.